So what's truly going on behind the headlines for, well, one of the most talked about companies in the world, Tesla? You see the cars everywhere, right? You hear the news constantly. But figuring out the full picture, the really complex stuff, it can feel like trying to untangle a bowl of spaghetti. Well, that's exactly why we're here today.
Yeah, this deep dive, it's all about Tesla's latest Q2 earnings report and, everything kind of swirling around it. We've pulled together key bits from their earnings call, their investor documents, recent market analysis, really trying to give you a clear view.
Okay, let's unpack this then. Our mission here is to pull out the most important nuggets of knowledge, maybe some surprising facts too. Basically, give you a shortcut to being properly informed about where Tesla is right now and where it might be heading, which is always fascinating and often pretty unpredictable. We're going to explore that tension, between their really big, ambitious long-term vision and the immediate market realities they're facing.
So let's dive right into those Q2 numbers. How do they actually do? Well, looking at Tesla's Q2 performance, it was generally seen as a miss compared to what analysts were expecting. They reported revenue of $22.50 billion. That's just a bit shy of the $22.64 billion consensus estimate from Bloomberg. But what's really striking, I think, is that this is actually a 12% drop compared to the $25.05 billion they reported just a year ago.
Okay, so revenue down year over year and a miss on expectations. Were there other parts of the financials that stood out as, well, concerning, and how did the market react right away?
Yeah, beyond revenue, adjusted earnings per share, or EPS, came in at 0.40 cents. The expectation was $0.42, and operating income was $923 million, whereas the street was looking for something closer to $1.23 billion. So these aren't tiny misses. The market definitely noticed Tesla stock was pretty volatile in after-hours trading, and then it fell more during the actual earnings call. It was a clear signal of disappointment.
Right, a definite sign the market wasn't exactly thrilled. But there was one detail that really jumped out to me, this thing about regulatory credits kind of vanishing. Can you maybe explain for listeners what those are and why it's such a, well, a big deal that they're declining so much?
Absolutely. That's a really significant point. These regulatory credits, they're basically payments Tesla gets from other car manufacturers. The ones who aren't meeting emission standards and need to buy credits from companies like Tesla that only make zero-emission vehicles. So this revenue source, it dropped really sharply, down to $439 million from $890 million just the year before. And this isn't just like a small dip. For years, these credits were a super reliable, high-margin income stream for Tesla. It really helped fund their growth.
So it kind of subsidized things.
Exactly. It was almost like free money in a way. Yeah. And now that it's vanishing, or at least shrinking fast, it forces a pretty fundamental shift. Tesla has to find profitability purely from selling cars and energy products, which is, frankly, a much harder game. And this trend, it's actually expected to continue, especially after this bill they're calling the One Big Beautiful Bill, or OBBB, passed.
Okay, so a major source of, let's call it easy money, is drying up. They really have to stand on their own 2 feet financially now, much more so. Yet even with these financial headwinds, the shrinking credits, what's really intriguing is how optimistic Tesla still sounds about the future. They're talking about expanding their vehicle lineup, specifically mentioning first builds of a more affordable model back in June, with volume production planned for the second half of 2025. What's driving that confidence when the current numbers tell a slightly different story?
That does raise a big question, doesn't it? Because despite saying this, we haven't seen any actual indications, not even like a drawing or a rendering of a new vehicle, especially not one priced around, say, $30,000. Just for context, right now, Tesla's cheapest car is the rear-wheel drive Model 3 sedan, and that starts around $43,000 before any incentives. So there's a big gap between the talk and the current reality.
Right. And what about the robo-taxi? That's been talked about for ages.
Still on the schedule, apparently. They're saying volume production starting in 2026.
Okay, 2026. But it's not just about these promises way down the line. They are actually expanding robo-taxi testing right now, aren't they? Which sounds like progress, but also maybe a huge challenge given all the regulations.
Indeed, we are seeing them expand the robo-taxi testing, particularly in Austin, Texas. They've got a bigger operating area there now. And Musk has said they intend to expand testing to the San Francisco Bay Area, too. But reports suggest they haven't actually submitted the applications for the state permits needed there yet.
Ah, okay. So intention versus action.
Sort of. And separately, Bloomberg reported Tesla's also talking with officials in Nevada about testing the service there. So the ambition is definitely clear, but these practical hurdles for getting robo-taxis deployed, expanding the testing, getting all the regulatory green lights, it really highlights how much Tesla's future depends on factors outside their direct control.
And that leads us perfectly into the role that policy and just the broader market environment are playing right now. Let's talk about that OBBB bill and the looming tax credit expiration. That seems huge.
Yeah, the CFO, Vaibhav Taneja, he specifically talked about the OBBB and its impact. He mentioned this pull-forward effect on sales. Basically, customers are rushing to buy now before a deadline hits, which could leave a gap in demand later on. This rush is all about people wanting to grab that $7,500 federal tax credit before it expires at the end of Q3.
So, this sudden burst of sales, this sugar rush, as you called it earlier, it's actually creating a supply problem for them now.
Exactly. Taneja sounded genuinely concerned. He said, and I'm quoting roughly here, given the abrupt change, we have limited supply of vehicles in the U.S. this quarter.
Oh,
He even warned that Tesla might not be able to guarantee delivery for orders placed later in August or beyond. So yeah, if you were thinking of ordering a Tesla to get that credit, you might already be pushing it.
wow. Okay.
And here's a really striking point from Taneja. The strategy, he said, is that Tesla plans to ramp up volume production of that upcoming affordable model only once the current EV tax credit expires.
Wait, so they're planning to bring out the cheaper car after the big incentive disappears? That sounds counterintuitive.
It does, doesn't it? It's almost like they're acknowledging that this affordable model will be most needed precisely when the government support goes away. Elon Musk himself even admitted Tesla could face a few rough quarters once that credit expires. So this pull forward gives them a short-term boost, sure, but the massive question is what happens next, after the credits end, especially while the overall market, like the S&P 500, seems to be doing so well.
That is a really interesting contrast. The S&P 500, the Nasdaq, they're hitting new highs, seemingly ignoring things like tariff wars or global slowdown fears. Yet Tesla seems to be under some very specific pressures. What are those key pressures beyond just the earnings numbers themselves?
That's right. Well, there are a few things going on. There's the potential reputational impact for Elon Musk connected to his political activities. That's one factor some analysts point to. Then there's simply the rise of more competition. Many more EVs are hitting the market from established automakers and new companies too. And we're even seeing a bit of a shift maybe in U.S. consumer preferences with more interest in things like hybrids lately.
Hybrids making a comeback.
Yeah. And on top of that, there are specific regional weaknesses for Tesla. They've had ongoing issues in Europe, and the latest registration data suggests U.S. sales have been sliding a bit too.
And how did this all translate into their actual car deliveries for Q2?
Well, it clearly had an impact. Tesla delivered only 384,122 vehicles globally in Q2. That's a drop of 13.5% compared to the same quarter last year. There's also a question mark around the refreshed Model Y. Some commentary suggested its rollout may have blunted sales, which raises questions for management about its availability in Tesla's key markets. It really makes you wonder if even a giant like Tesla is starting to feel the pressure of a more mature, definitely more crowded EV market.
It sounds like it. And did Tesla themselves acknowledge any of this uncertainty?
They did, actually. If you look at their Q2 shareholder deck, they included a statement something like, "It's difficult to measure the impacts of shifting global trade and fiscal policies on the automotive and energy supply chains, our cost structure and demand for durable goods." It's basically an admission from them that, yeah, even they are navigating some pretty choppy, uncharted waters right now.
So what does that mean for their outlook? They're still investing, right?
Yes, they talk about making prudent investments for growth, both in vehicles and their energy business. But they're also quite clear that the actual results, what really happens, will depend on a whole range of factors. Things like the wider economy, how quickly their self-driving tech actually progresses, the production ramp-up speed at their factories. It's a lot of moving pieces.
It really is.
And they seem to be acknowledging that, ambition alone doesn't guarantee success in this environment. It's a complex balancing act they're performing. High stakes, really.
Okay, so let's try to sum this up. You've got this company, Tesla, with these incredibly ambitious plans for the future affordable cars, robo-taxis, the works. But right now, they're facing some pretty serious immediate challenges. Financial headwinds, that big drop in regulatory credit income, complex market forces driven by policy changes, shifting consumer tastes. It really does feel like a fascinating tug of war between that future vision and the pressures of the present day.
It absolutely is. And it makes their next moves, the next few quarters, incredibly critical to watch.
Definitely. And maybe here's a final thought for you, our listener, to chew on. Given Tesla's stated strategy, this plan to ramp up production of a more affordable model after that $7,500 tax credit disappears, What does that really tell us about how they view their long-term vision versus the short-term market realities they have to navigate right now? And thinking bigger, what could the impact be on the whole EV adoption landscape if one of the biggest players seems to be intentionally holding back its most affordable option until after the main government incentive is gone? It's a really interesting question, and one we'll definitely see play out in the months and quarters ahead.